Welcome to our High Rock monthly video for July. I'm Scott Tomlinson, and with me on the call today is our portfolio manager, Paul Tepsich, and also he is the founder of High Rock. Well, let's talk about a little bit what happened in June. There was certainly a haze cast over lots of North America from forest fire smoke. But more importantly, it looks like financial markets, for the most part, came back from a difficult May, and June was a better month. Let's look at it from a year-to-date perspective. Most financial assets are recovering from a very difficult 2022. Although preferred shares and REITs are still struggling. As you may recall from past monthly videos, we don't own any REITs. Paul, do you want to add to what your thoughts are on the whole REIT sector?
Well, we haven't owned them for many years due to what we think is kind of suspect accounting on capital expenditures. But more recently, over the past 6 or 9 months or so, post-COVID, a lot of commercial property REITs are going to run into problems here. So there's a lot of fear in the marketplace, quite frankly, in North America and Europe about commercial real estate. So that is why you see that in the negative column right now. But that could be a big thing for the markets moving forward.
Yeah, I totally agree. And of course, preferred shares have not been a great performer this year, but we began to restructure our preferred share strategy in late 2022. So I know you've talked about that regularly on these calls, but you may have a snippet to add.
Yeah, we still own one rate reset preferred share, which is benefits from rates moving higher. Thankfully, we kept that one. The two others that we swapped out of rate resets into fixed rate, over the past month or so, as rates have moved higher, they've actually hurt us a little bit. But that's more of a longer term trade, as we think rates will eventually move down due to one thing or another, being inflation or economic weakness.
Yeah. And again, we look at where balanced portfolios have been bouncing back from a difficult 2022, and more specifically, one of the comparisons we make is against the iShares Core Balanced ETF, and certainly it had a very difficult 2022, and likely in almost all of our client portfolio balanced situations, they were significantly better than they performed significantly better than this particular ETF as a result of our ability to mitigate that downside. We may not be bouncing back as quickly as this ETF is, but we certainly didn't see the same downside in 2022. So all in all, it makes our portfolios look pretty good. And more on that, in fact, we can talk about the risk and the return factors of that XBAL, which is the designated portfolio A, and also the only holding. So just to make it clear, what we're looking at here is the risk on the bottom axis, the return on the vertical axis, and how XBAL has performed over the last 3 years on a risk and return basis. What we want to highlight here is that most of our client portfolios have performed in this general area, and we would, because all our client portfolios are specifically designed for their circumstances, to capture their goals, to understand their risk tolerance, to know their time horizons and their ultimate cash flow needs. So all of our client portfolios are different. So we want to encourage our clients to have a conversation to find exactly where their portfolio might sit on this particular scatter plot. But the idea here is just showing where that ETF XBAL has performed over here where the red dot is, the red and the gray dots for that matter, and then compare where they might be relative to the risk and return in their portfolios. Also, and Paul will elaborate maybe a little bit more on this, but our high yield mandate has shown considerably less risk, and the return is off this particular chart. So again, those are conversations that we're happy to have individually with our clients to be more specific about their circumstances and their situations. This is just an encouragement to make sure we have those conversations. Paul, anything to add on this?
Yeah, this is quite frankly what these type of risk return charts show, and it is something that we always focus on. Is as a client or an investor, you always want to have the highest potential return, but very importantly, you have to keep an eye on risk. So you want to have the highest return with the lowest amount of risk. So if I said to you, in this particular portfolio, which is a balanced portfolio, the portfolio A in red and the gray holding all the same, if you could have, say, a return that's twice as high, but as opposed to roughly 9.5% standard deviation, if you could have that at 4.5, you'd be thrilled because you're taking less risk and you're getting the same or higher return. So everything we do is try and manage that risk and get as high a return as we can with the least amount of risk we're taking, or how much return we're getting per unit of risk that we are taking. Ideally, in this chart only goes up to 6% return over the last 3 years. You want to be in the top left part of this chart. That's where you'd ideally want to be. So anyone wants to, I think I encourage all of our clients or any prospects to ask more details about where in fact your portfolio lines up on a chart that looks like this.
Yeah, that's great. Absolutely. And speaking of high yield, Paul, any updates you want to put forward as far as that part of our mandate, that specific mandate that we?
Yeah, we did over the past month. We did add just late in June. We did add to about 5 or 6 existing positions to spend a bit of cash. We've continued to have a high weight in energy-related bonds, which has worked really well for us over the last 3 years. But so well, in some cases, we've had our bonds, most of these oil and gas producers have had massive cash flow. They've cut expenses, so they have a lot of free cash flow and they're paying down debt. So in some cases, we've actually had bonds called from us or bought from us by the issuer, by the company themselves. So we had a little bit of a cash build. We actually added to it, and we think now is actually a very good time to be buying 3, 5, 7-year fixed rate high yield debt, corporate debt. So we did add to about 5 or 6 positions for those mandates. And we will look to continue to do that over the next months. And that's about it for that high yield mandate, Scott.
Okay, great. Thanks. And just a reminder to everybody that that your portfolios are based on your long-term goals. So it's always important for us to be reviewing those and to make sure that we're adjusting our strategies accordingly. Something we've been a little bit concerned about for the last little while is inflation. Certainly in Canada, inflation has been coming down as the Bank of Canada has been raising interest rates. I think we're of the mind, Paul, and I know that you'll agree that central banks in general tend to overdo it on either side of when they're easing or when they're tightening. And certainly the expectations are that they are over tightening. In this case, inflation is coming down, and it's coming down rather quickly. And if it continues to come down as quickly as it has been coming down, there's probably going to be some economic repercussions over a longer period of time. And we can also look at what's been happening in the United States as well, because while their inflation levels haven't been coming down to the same degree, it is still a fairly steep slope down from the peak. And we do still anticipate that there will be more interest rate increases coming from the Federal Reserve. So, Paul, I'm not sure if you have anything you want to add in here, but certainly it does impact how we look at moving forward, especially with our investment strategy. I'll talk about that a little bit when I talk about the global equity strategy.
Yeah, I would just comment on both Canada and the U.S. independently, but and similarly. So I would agree with the overall theme. We know that for a fact. You can go back historically. We've written blogs on it. Every recession starts with the Fed and the bank hiking rates too much, too quickly, and they overdo it on both sides. We all know now, back in 2020 during COVID and 2021, that they kept rates too low for too long as inflation was moving up. We can see in this chart right now in front of us, the U.S. The other thing I would mention, though, that's very important is fiscal policy. Right now we're just looking at monetary policy, being the central banks raising or lowering the overnight rate that large banks can borrow at with each other. So I think we need to think about fiscal policy. So two things. One, in Canada, what was the deficit just came out at like 60 billion. These are enormous numbers that go into the economy. That in itself adds to inflation. And I think what we're seeing both in Canada and the US is the central bank needs to combat that with higher rates. So the one side, the government, through fiscal policy, is giving us money by running massive deficits. And in the US, putting in the IRA and the CHIPS Act, et cetera, that puts money into the system. On the other side, the central banks need to take it out and punish small businesses and consumers. We being both, quite frankly, Scott, we're both consumers and we run a small business. So that's problematic. In the US, the difference is, I think, is the military complex, which is firing on all cylinders right now with the war in Ukraine. So that is very, very good for the US economy. And I think that's one reason in the US that they have a leg up on Canada with regards to economic power that we just don't have.
Interesting. And certainly a great deal of the Canadian economy over the last 10 years has been the growth of the real estate market and all of the reciprocal economic advantages of a strong real estate market. That may come to a grinding halt in the not too distant future, I imagine, right?
Good. Yeah, good. But there's a lot of immigration coming in too. But yeah, that's, these high rates have to bite a little bit.
Yeah, exactly. Anyway, so generally based on our economic outlook, our global equity strategy remains pretty neutral, although as we rebalance client portfolios with the bounce back in equities in general, we start to see that clients are becoming a little bit overweight with some of their equity holdings, and as there are cash flow needs, each client again has specific needs for cash flow. But as we see cash flow needs, we're more inclined to be taking sales of equity holdings as we rebalance the portfolio rather than bond holdings, which we think still have significant value. So I'll let Paul address that when he talks about the fixed income. But first, I know you've updated on the high yield. How does that impact some of the tactical model, Paul?
Yeah, just in general in the tactical model, we didn't really have any trades going on. Gold was down. We do own a small amount of gold. Oil has been hit, affected our Baytex stock, which did make a massive acquisition that closed in June down in the US. So they have a lot more exposure to oil, and as people probably know, OPEC seems to want to put draw a line in the sand with WTI oil at $70, but it's been very volatile, both below and above that $70 mark. So there's some fear certainly in the oil market. One piece of news that came out late in June for stock and bonds that we own is Sherritt. They did something kind of interesting, and I won't get into the complex details of it, but we own a very small amount in the balanced portfolios. The high yield mandates own a much larger amount. They have a bond, a subordinate or junior level bond that is a 10 3/4 coupon, but for the past 3.5 years it's been in its existence. It doesn't pay cash interest on the coupon every 6 months. It was paying it in kind with more bonds. It's called a PIK, or payment in kind. The company announced a couple weeks ago that they will now start, as of July 31st and January 31st, the two coupon payments will be made in cash. And there's a very specific reason why they did that. It will only cost them about $7 million a year in cash. But as they said twice in the press release that night, it's the first step in allowing them to return capital to shareholders. So for our stock position, which is far bigger than our bond position for the balanced portfolios, this is a very, very good thing. So that's the one piece of news really in the tactical strategy. Otherwise, there were no real trades in there.
Excellent. Okay, and as far as fixed income strategy?
Yeah, we talked about preferred shares already. Rates have obviously backed up, and quite frankly, even the past week, today's July 7th, they backed up quite substantially. I was just looking at the 5-year Government of Canada rate in May was at 280. Today it's at 390. So we backed up 110 basis points in just over a month. So quite frankly, government bonds, anything interest rate, any securities that have interest rate sensitivity, government bonds being the most, investment grade bonds having some, preferred shares having some, did not perform all that well the past month. But our high yield bonds in the fixed income did quite well. And these are bonds that yield anywhere from 6 to 9% that we own. So they're, as I said before, with regards to our high yield mandates, that's a yield that we think is quite attractive from a risk return perspective. So again, there were really no trades other than for newer clients that we were picking away and adding to, quite frankly, every security in the fixed income bucket. That's it.
Yeah, and just a reminder to clients too, and these are conversations that I'm having on a more regular basis, but there's a difference between how we look at our fixed income part of our portfolio, because for the most part, we expect to hold most of the bonds we own to maturity, and bonds have, with higher interest rates, pricing lower prices. And that does affect the current value of the bond part of your portfolio. But if we are to hold those bonds to maturity, because the prices are discounted now, there's some potential for pretty significant capital appreciation in the portfolio. So where your portfolio is marked to market against the current bond prices doesn't necessarily mean that there is not a whole lot of value in those bonds as they're held and when they move towards maturity. And it's just something to keep in mind. And again, remind people that those are conversations that we want to have with you if you have some discomfort about where current bond prices are sitting.
Oh, Scott, that's a really good point that you brought up, and I should have mentioned that. That's part of the reason why we were adding bonds to the balanced fixed income model, but also that high yield mandate as well. I'll just give you an example. The high yield portfolio we have has about 25 bonds in it. 3 of them are marked at par, being 100 cents on the dollar or higher. The other 20 odd are all discounted to par. So that's called pull to par. These bonds are eventually, as they come closer to maturity, are going to move from 85 cents on the dollar to 90 to 95 to a par, 100. And as you said, that's a lot of capital gains appreciation. So it balances out on an after-tax basis very well. So that's part of our motivation for adding discounted bonds right now.
Excellent, excellent. And thanks for that update. All right. Well, as always, we want to thank you for taking the time out of your busy schedules to be with us for this video. Probably a bit longer than we'd like it to be this month, but lots of important information. And again, I stress that each client portfolio is different. And when you get your next quarterly summary, which will come out sometime later in July, we want to make sure that when you're reviewing that, if you have any questions, you want to talk about strategy, that you get in touch with us, because that is really important part of our client communication. But on that note, I want to make sure everybody's having a wonderful summer. Have a great July. We'll be back at the beginning of August, and we'll until then, we wish you all the best.